Today we are going to talk about the concept of contingent liabilities. IAS 37 helps users to assess whether or not to disclose events such as pending lawsuits in a financial statement. In order to understand what contingent liabilities are and how it differs from a liability, it's important to understand what a liability is. A liability is recognized when both the definition and the recognition criteria is satisfied. The definition of a liability is a present obligation of the entity to transfer an economic resource as a result of past events. The recognition criteria is satisfied when outflow of resources is probable and the cost or value of the obligation can be measured reliably. Keeping that in mind, we'll now look at the definition of a contingent liability. The first type of contingent liability is a possible obligation that arises from past events whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. That basically means that the obligation is possible. It's not a present obligation, it's a possible obligation. And the occurrence or non-occurrence is dependent on a future event, and it's also not controlled by the entity. So this is not a liability because the definition of a liability is that it's a present obligation. However, for contingent liability, in this case, it's a possible obligation. Another type of contingent liability is a present obligation that arises from past events, but it is not recognized because the outflow of resources is not probable and the amount of the obligation cannot be measured with sufficient reliability. So this also doesn't satisfy a liability because in the definition of a liability, the cost of value can be measured reliably. However, in this type of contingent liability, the amount cannot be measured reliably. Now we'll look at the application of probability criteria. This table shows you how to apply each case. So for example, if there is a present obligation and probably requires an outflow of resources, a provision is recognized and disclosures are required. Now we'll move from present to a possible obligation. If there's a possible obligation, it may, but probably will not require an outflow of resources. No provision is recognized, disclosed as a contingent liability. If there is a possible or present obligation, however, the outflow of resources is remote, no provision is recognized, no disclosure is recognized. And lastly, this one's quite rare, however, where there is a liability, but it cannot be measured reliably, no provision is recognized, disclosed as a contingent liability. Now, to understand a little better, we'll look at a case scenario. A restaurant is involved in a legal dispute with a customer suing for $100,000 in damages due to food poisoning. Management believes they will be able to defend against the lawsuit, and lawyers advise that there is a 70% chance that it would not be liable for the damages. So if we apply this to the table we looked at earlier, is it a present obligation? If we look at the case facts, a restaurant is involved in a legal dispute, so it's still going on. It's nothing certain yet, so it's not a present obligation. So look at the third one. Is the outflow of resources remote? So looking at the case facts again, there's a 70% chance that it would not be liable for damages. There's still a 30% chance that it would be liable. So I wouldn't call that remote. So no, this would not apply in our case. So lastly, we'll look at the second one. It is a possible obligation. It probably will not require an outflow of resources, but it may. There's still a 30% chance that the restaurant will lose the case. Therefore, no provision is recognized. However, it must be disclosed as a contingent liability. I hope you now understand the basic concepts of contingent liabilities.